All right, let's start. Any questions so far? So let's talk about a little bit about the exam policy, and then we can go for exam and questions. So the test is about hour and 20 minutes. But if you all can come early and settle down, PA can start up. But if all can, if not, the PA will start at 9. I should not be proctoring. I have an assistant, teaching assistant, she will help and she will proctor. Make sense? And if you need some more minutes, you can get 2 to 5 minutes even after 10, 20. Make sense? But I believe you should not require that. It should not be that scary like you need it for it. Okay? But if you can come early, you want some more minutes, you should be fine. So it's around an hour and 25, something like that. Make sense? Write your full name. The name as it appears on the two-man system so that I can find it out. Okay? Close book, close notes. You cannot bring anything. All of your stuff, laptops, whatever you have, try to keep aside. Okay? You can only allow to have pen, pencil, calculator. I prefer factor calculator or just a basic calculator. I don't prefer all those TI engineering type calculator. Okay? Pen, pencil, calculator. $20 MCQs should be pretty easy. 20 MCQs, and each oath 5 points. Make sense? You know that about scratching on the test. You can. So basically, your first page should look like this. Your page 2, 3, 4, 5 is all about the problems which you need to answer. You can scratch there. That's fine. 2, 3, 4, 5. You can scratch there. I give you a blank page on the page 6. You can also do whatever you want. Okay, there should be a white page. If you need more space for sketching or something you want to do, you can also do there. Now, you will write your answer only on this page. Okay, so this should be the very last page of your test. If you want, you can just take it out, put it in front, and then when you are turning in to the proctor, stamp it. Make sense? Easy. So you don't need any Scantron, don't need to bother about anything. But very important information. This page should be neat and clean. I don't want anything unwanted on this page. Because in history, I find that sometimes you write something which is difficult for us to grade. Okay? So this page should be neat and clean. You can only write A, B, C, or D for each specific problem. Make sense? No scratching, no extra work on this page. And you will have to write your name too here. Only write your name, very first page, and this page. Okay? Formula sheet, you already have it, right? You have the same thing here. So the very last page is formula sheet and answer sheet. Take it out and make sure the answer sheet is neat and clean and tight. Any questions about the exam policy? What to expect, when to come here, Tuesday, 9 to 10:20. If you all can come a couple of minutes early, you have some extra minutes. But if all not, then it's not. It has to appear. Make sense? Any questions about material? Any topics? Do you want me to go over on anything specifically you want? Yes.
For the balance sheets and income statements, are we gonna have to like create one, or is it just no?
Okay, so good point. So I'll talk about this. Okay. Anything else? So we'll go over. It's any other questions?
I was gonna ask you just briefly go over the pro forma and like the plug variables.
Okay, so same, almost kind of same thing, right? Okay. Okay, so we'll go over that, but let's have some quick review, like how you should prepare. Okay. So starting from chapter 1, what are some specific 3 components we studied for corporate planning? Alex?
Corporate budgeting, capital structure, and working capital management.
Absolutely. So basically, I want you use this guideline, and from the slide or from the notes, study step by step. Capital budgeting, capital structure, working capital management. So when we plan for our fixed asset investments, that is capital budgeting. When we plan for debt and equity structure in our capital, that is capital structure. When we plan for managing our short-term liquidity, short-term money, we're talking about working capital management, right? What are some forms of business we learned from this class?
So partnership management.
Absolutely. So try to know very specific characteristics, some advantages, some disadvantages. What are some very specific characteristics? Sole proprietorship owned by one owner, right? Partnership more than one. For corporation, it is always a separate entity, right? Some advantages, disadvantages. For corporations, double taxation, right? So if you go to the slide, know the definition, very specific characteristics, advantages, disadvantages, right? What is the agency problem? When there is an agency problem,
You're hiring somebody to like manage something for you, your ideals and goals don't align. That's your problem.
so when you think about corporations, it's a separate entity, right? And for corporations, we always have managers who manage the firm, and maybe someone else provided the capital, right? We call them stockholders, right? So when managers do not work for the best interest of owners, then there is an agency problem. And what is the problem? They are not maximizing shareholders' wealth, right? Then there is agency problem. There are 2 types of cost: direct cost, indirect cost. So what are some example of direct and indirect cost? When they spend for luxurious items which is not required for the business, right? When they do not undertake positive entry projects to maximize share value, this is a direct cost. Indirect cost: when you have to appoint some external party to monitor your managers, you have to pay some fees. That is the indirect cost. So know the agency problem, know the cost associated with the agency problem. Financial market: when we want to transact an instrument and financial securities, we have to go to the market, right? We go to the financial market. The most important distinctions are primary and secondary, right? How we can differentiate primary and secondary financial market? Alex?
A primary market is where securities are being listed for the first time, and then the secondary is any transaction that's been through a process like when it's listed.
Absolutely. So when the real corporation, the user of fund, want money, they get the money from the investor, right? When there is a transaction between user of fund and the investors, we call it a primary market transaction, right? Because the security is listed on the market with a very fast. But subsequently, when investors want liquidity and they want to sell off their holdings, they go to secondary market transactions. In secondary market, investors basically trade with another investors. They don't trade with user of fund. So this is the secondary market transactions. So any confusions about like a typical balance sheets or typical income statements? It's really important to understand, like, I'm not telling you to memorize, but it's really important to understand how income statements are prepared. Because going forward, when you go over the pro forma for income statement and balance sheet, if you really don't know how they look like, then you'll not understand what's going on, right? And on the test, you will see something similar problem. So it's really important to understand basic structure of income statements and balance sheet. Now, it's also really important to understand some basic definition, like net working capital. What is a net working capital? The difference between current asset and current liabilities, right? Liquidity. What is a liquidity? When you talk about the liquidity of any asset, how can you define the liquidity of any asset? Emily? Okay, that's it.
Without like losing it.
Absolutely. So two factors. How quickly we can convert the asset into cash, first factor. Second factor, without losing significant amount of value, right? Make sense? So understand the basic definition of liquidity, net working capital. Market value, book value. What is the difference?
The book value is the value at which something is marked down on the balance sheet, and the market value is the actual market price for which it's bought and sold.
So yes, absolutely. So you can think about when you talk about the market value, let's say this is my fixed asset. So market value is what investors are willing on an average to pay for this asset. What investors are attaching the value for this asset on the market. That is market value. Book value is basically how much I paid for it when I bought it, minus if I occurred a depreciation or not. So basically, book value is the way how I'm reporting it in the balance sheet. Matching principle. What is the matching principle? Yeah,
Expenses have to equal your sales.
absolutely. One more thing. Matching principle. When we earn any sales or revenue, it has to be reported on that fiscal period, right? Irrespective of when you're getting the cash. At the same time, the expenses we actually incur for generating that much of sales, we have to match it, right? So that is called matching principle. Also practice those sample questions from the slides. Those are really, really helpful. You'll see a couple of problems similar to those sample questions. Taxes. Do we know the difference between marginal tax rate, average tax rate? What is the difference? What is the marginal tax rate? What is the average tax rate?
So the marginal tax rate is what you're gonna pay on the next dollar you earn. So if you're at like 10,000, then the next bracket starts at 10,001, your marginal rate is gonna be that, the next bracket. Your average tax rate is just, it's just however much you pay in tax. I forgot, but it's just your average tax rate. How much you pay the taxes over.
Almost there. Okay,
Yeah.
so let's look at this tax rate, right? So you know that federal income tax are progressive, right? The more you earn, the more you pay, right? So basically, the total tax is paid on your taxable income. If you divide your total tax paid by taxable income, which is average tax, you can say that on an average, how much you pay from your taxable income, that is average tax rate. Now, if you earn $1 more from your current income, how much you have to pay for earning those additional $1? That is called marginal. If you, let's say, fall in here, 200,000, that's your current income, let's say. You got a second job for $1. For that additional $1, you have to pay 39%. By earning those additional $1, you have to pay 39%. That is your marginal tax. Why marginal tax should be important? Because if you want to take one more job, if you want to earn some more income, you have to pay that much. That is important. Now, for this year, how much on an average you paid on your 200,000 income, that is your average tax. Make sense? Know the definition. We did this practice in class. Try to go over the practice. Okay. Know the very specific components of this cash flow from assets. Okay. And cash flow to creditors, cash flow to stockholders. Inclusion here, cash flow from assets should be equal to these two components, right? So make sure you understand specific components of these cash flows. Formula is on the formula sheet. You can see the same formula on the formula sheet. So don't bother remembering that. Okay, memorizing that, but understand what's going on. So if we decompose cash flow from assets, it's coming from operating cash flow. You deduct net capital spending, you deduct changes in net working capital, right? And what is the other name for this equation? There is another name for this equation, this area. Cash flow from assets. Free cash flow, right? So this is the cash flow free for whom? To pay stockholders, bondholders, right? So the other name for cash flow from asset is free cash flow. Anything you're generating from business, you have to deduct. If you need any more fixed asset from the business or not, you have to deduct if you need any more money for working capital investments. After that, whatever you have ready to go to creditors and stuff, right? So make sure you practice these problems. You can see similar problems. Now, cash flow to creditors. It's cash flow to creditors. If I am the company, you are my creditors, it's the cash flow towards you, right? When I can pay you, I can pay you interest, right? And I can pay you, if I pay you back, your bond value or loan value, right? So that's why interest paid minus net new borrowing. If I borrow more from you, that's not a cash flow to creditors, right? So that's why we're deducting net new borrowing. Make sense? Because if I get more borrowing, I'm actually receiving the cash. I'm not paying you the cash. Similarly, cash flow to stockholders. If I'm the company, you are my stockholders. How can I pay you? I pay you the dividends and net new equity raised. Question so far? Okay, moving on to common size. So if we want to common size our balance sheet, all of the components will be common size against. So total asset, right? For income statement, we should common size against. So don't get confused, okay? So for income statement, don't common size against sales. So the way we do common size, balance sheet against total asset, income statement against sales. Ratio analysis, one of the most important tools if you want to do what? Analyze and form, right? To make sure you can understand those formulas, plug in values, and you can interpret. You don't need to memorize the formulas. Okay? Plug in the values and you can interpret what's going on, okay? These are some liquidity ratios. Very general interpretation. Higher the value, better liquidity the corporations have. Very general interpretation. There is not a certain threshold. Higher the value, better liquidity, right? Long-term solvency. Higher the value looks like you have more debt, more leverage, right? Just go over these coverage ratios, inventory, receivables, asset turnover. These are all like efficiency ratios. Yes. That should be on the formula. On the formula, you will find formulas on here. So you need to know how to plug in values and how to interpret. Let's say one firm has 10% ROE, versus another firm has 15% ROE. What is the interpretation? Which one is doing better? Which one you prefer? Right? That's it. If you need any formula, you'll get it. So on the test, if you are confused that I don't understand what's going on, I don't have the formula I need for, feel free to inform your doctor. Okay? The doctor can communicate with me and I can let you know whether you have the formula there or you need a formula. Okay? Or for any specific wording. From the very first class, I cautioned you the main problem in finance is wording. Same thing has 10 different names. If you feel like, I don't know what is that, but I have learned something else in the class, feel free to inform the proctor. Okay? Make sense? Then also try to understand P ratios. What does it mean, higher P versus lower P, right? That will basically two mean. If you compare firms from two different industries, having higher P versus lower P, higher P means growth firms, lower P means value firms, right? But when you compare similar firms to twin brothers, higher P means overvalued, lower P means undervalued, right? So you have to be careful in interpretations, okay? And also, there is one drawback of price to earnings ratio. What is that? So what is the problem of using price to earnings ratio?
It only works if the firm actually has
Huh?
It only works if the firm actually has earnings.
Positive earnings. Positive earnings. Negative earnings is also an earnings, but negative, right? So the problem of price to earnings ratio, it is not meaningful if the corporations have. Then we have to find alternatives, right? Maybe price to sales, price to book value, maybe EBITDA, lot of other alternatives, right? If not, this is one of the most widely used ratio in the industry. Now, DuPont analysis. What we learned from this step, what we did on this step. It has three components, right? Profit margin, asset turnover or asset efficiency, leverage, right? So what is the understanding or interpretation you learned from this table? So DuPont basically help you to understand the return on equity of the firm, right? Whether they are generating higher return on equity because of more profit margin, more efficiency, or leverage, right? And the thing is that leverage is good if you are having good time, which is higher profit margin, right? If not, leverage is not good for yourself, right? If you're having bad times, negative profit margin, you're not doing well in your business, leverage will make your bad look further bad, right? On the other hand, if you're doing good business, leverage is good for yourself, right? So try to understand these three components and how these three components is affecting each final value. Questions? Why you do ratio analysis or statement analysis? Performance evaluation, right? Internal uses, external uses. It's always better to do in terms of benchmarking, right? One specific ratio does not give you interpretation, right? You have to look at same firm all the time, or you have to look at different firms, similar different firms at the same time to compare who is doing better, who is not. Okay. And there are some problems of doing ratio analysis because it's tough to find comparable firms. Sometimes comparable firms have different fiscal years, different time period. Just go over the interpretations. So moving on to pro forma, right? So that was our main problem, right? Let's see. So for pro forma, what do you need to understand? So we start our pro forma with what? What is the first step in the pro forma analysis? If we have historical income statement, if we have historical balance sheet, the first step for pro forma.
You need to determine what percentage of things are, you need to determine percentage of sales for everything in terms of percentage of sales.
Okay, that we have. So that's from historical analysis, right? That's not pro forma. If you have historical statements, we can easily do in terms of sales, right? But for pro forma, what is the first step?
Figuring out what to invest in. Like if you should invest in your fixed assets or liquidate.
Okay. Anything else? What is the first step in pro forma?
Identify the presumptions that are going to be used in order to prepare your documents.
Okay. What is the first step of pro forma?
Do you have to figure out what your plug variable is gonna be?
What is the first step of pro forma? if we have a historical statements, yeah, assumptions definitely required, because that will help you to think about the model, right? But what assumptions? What is the possible performance? What is the possible performance? If you know all of the new values, you're done, right? You are finished with your pro forma. Your first step of pro forma is know your cells next year. Know that's the most important thing. That's the most important thing, and that's the first step of the pro forma. You know yourself. All else, you can just do historical ratios, right? You can, but which is not appropriate sometimes, but you can. So if you have, let's say, go to this example, this is really good. Okay, so let's say our history, right? From the history, we can easily calculate historical ratio in terms of cells, right? But the very important thing, the first step in pro forma cells. What should be my cells next year? So, how you should prepare for the test, right? For pro forma. So let's say this is given. Hypothetically, let's say this is given. Can you calculate those ratios? And let's say your next year sales is also given. So hypothetically on the test, it said last year sale 1,000, next year sales 1,200. Now, if you know all those historical ratios, can you generate? The sales will be given, right? Can you generate? What should be your EBT, net income? How much should be dividend payment? How much should be additional dividend earnings? Can you? If you can, next step should be balance sheet. If you are given historical balance sheet, you know yourself, make the ratios. On the plug variable side, now the question is, how can you decide the plug variable? So in reality, plug variable is an independent decision by the managers. On the test, it will be say that what managers want to do. If it says managers want to do all dividend paid, no return earnings, do accordingly, right? Or it can ask you, think about you are the managers, what you want to do. Makes sense? Historical information will be given if needed. Next year sales will be given if needed. It will either ask you what should be your pro forma income value, what should be your pro forma this value, okay? And then it may ask you either manager want to keep all the return earnings, no dividend payment. This is the plug variable, or it may ask you in that situations, if you are the managers, what do you want to do? You want to keep all income, all earnings, and how you should balance the balance sheet. So for your preparations, make sure how to calculate those historical ratios, just practice. And make sure if sales is given, am I able to generate a proper income statement or not? If sales is given. And then if sales is given, and if I was given enough information, can I use the plug variable and balance the balance sheet or not? That's it. Looks scary. Okay. Confusions. Yes, Rahul. One back one here. New dividends, we assume here. Dividends were 40%. Makes sense? This information will be given. So your job is to regenerate. That's it. If you can regenerate, you're fine. information will be given. So now dividend payout ratio 40%, this is on net income, right? This is not on sales, so don't get confused. Dividend payout is on net income, not on sales. So I forget who asked me pro forma and plug variables. Jack and who else? You. So you guys are good? So, and then understand what is the problem of percentage of sales approach, right? Because when you know the sales, we can think about cost of goods sold always vary itself, right? Interest payment, depreciation, they do not vary itself. Those are some problems of percentage of sales approach. Just understand the topic. Okay. So what are some problems if you do percentage of sales approach? Also go through these examples. If you're expecting some growth next year, do you need an investment in fixed asset or not? How can we decide? We can decide by looking at the information of our capacity, right? If we are not running at full capacity, we may not need an investment in fixed asset, right? Only if we are running at full capacity and we want to achieve 10%, 20% growth next year, we need investment in fixed asset, right? So go through all these examples and assumptions. Growth rate, internal and sustainable growth rate. So learn the assumptions. When you talk about internal growth rate, the very important assumption is we are not going to paste something. What is a very important assumption on internal growth rate? We are not going to issue any financing, right? So we will grow by using our retained earnings generated from the corporation, right? If you want to calculate the internal growth rate, this is the formula. Formula should be given on the test. You know that, you already have it. You need to understand how to calculate return assets, how to calculate retention ratio. Formula should be there. We calculate the growth rate. Sustainable growth rate. What are the assumptions? We use our money generated from the corporations. We will only issue debt. No equity will be issued, okay? We will only issue debt so that we can keep the debt equity ratio or the leverage ratio constant. Make sense? We'll use the cash flow from the corporations and then we'll issue some debt, not equity, so that our leverage ratio stays the same. And by doing that, how much growth at max we can achieve. This is the formula, should be on the test. You need to understand how to calculate internal equity and retention. Questions? Yes. Okay, sorry.
On the test, will the formulas be labeled like will one say sustainable growth rate, or will you just have the formulas?
You should already have it, right? Formula sheet.
Yeah. Oh, okay.
You should already have it. It should be the same thing. I just copied and pasted and give it to you. Again, if you think you need more formula, feel free. Let me know before Tuesday or feel free to ask the proctor. We can provide thousands of formulas if you need it. That's completely fine. So don't get scared like I need some more formulas, it's not on the sheet. Just inform the proctor. That should be fine. Final chapter, time value of money, right? From this chapter, you have to understand very basic definitions. What is meant by present value, what is meant by future value, what is meant by rate of return, what is number of periods. Just understand basic definition. Go over all the problems in the numbers. Okay, and then understand if we have higher interest rate versus lower interest rate, or if we have higher number of periods versus lower number of periods, how it is affecting the present value. Okay? I think we did it on the last class. We go with a couple of examples. We did it on the last class, high interest rate, low interest rate, higher number of periods, lower number of periods, how it's affecting. And also know the difference between simple interest, compound interest, right? Major difference on compound interest, we earn interest on already earned interest, right? On the simple interest, we never earn interest on already earned interest. We only earn interest on our principal interest. Make sense? Any questions before Tuesday? You still feel you have confusions, we have office hours today, I think 3 to 5. And also you can find me on Monday, okay? So maybe early morning or very late afternoon, you can find me on Monday. So feel free, if you have any questions, feel free to reach out to me, okay? If not, good luck. I will see you hopefully next Thursday, and good luck for it.